Welcome to the daily update, where I'll go over the action in the market for Tuesday, October 15th, and then we'll see how things look for Wednesday, October 16th. We finally saw a down day. So far, it's just looking like a pullback. We're still positive, but the one interesting thing is we were above average with volume. As we've been chopping our way higher, we've been seeing volume really dropping off. And then we have a down day and we see volume picking up. Little bit of a concern because there just appears to be a little bit more conviction on the selling side, at least in Tuesday's session. Now, Wednesday, we don't have any major economic reports coming out. Thursday is going to be the big day for that. So the market's just kind of playing off what's happening. We're still seeing, or we had seen, interest rates going up. Well, they're declining right now. We're still above 4% with the 10-year yield, but it's coming down a little bit. The dollar's been getting a little bit stronger. That could be putting some pressure on stocks. But when you take the short, intermediate, and long term, we're still above all the moving averages. We're still looking positive. We've worked off some of these extreme positive conditions, including sentiment that I talked about in yesterday's video. And we're just seeming to be working off some of this for right now. We'll keep an eye on this. If we continue to see things turn more negative and we see our charts start to shift more negative, we'll be right on top of that to see if there's an actual change that's happening. But for right now, it just looks like a normal pullback. I have a thing called the SPXInvesting Program. It's free until the end of 2024. Feel free to check that out. There are additional videos that I post. There's courses that I do. It's meant to be an all-encompassing type of program. And you can have time with me on Zoom or Skype to go through some things. There's a lot of pre-recorded educational things. There's live educational things. But if you're interested in that, there's a link in the description below this video that will take you to the website. There's also a link to a video that talks about the program. One benefit that you get is that right after the videos are uploaded, they're available to members, where I delay that on YouTube and Rumble. Also, the daily video, as I say in every video, that's the real foundation of the analysis that I do. Over the weekend is when I do all the outside videos, the weekly videos, and they're meant to tie into the daily video. So let's go back and talk about what happened. We did have a slightly higher open. Futures really didn't show any weakness before we opened up, and that was good right off the bat. You'll see some of the charts, like the new highs. With the higher open, we saw a really high reading with the new highs being generated, but it didn't last very long. Prices fell down below the unchanged level, down below the daily pivot at 58.54, and went down even below S1 at 58.36. Then we kind of settled there for a while. We chopped along S1, but then we fell down to S2 at 58.12, and we closed slightly above S2. We were down 0.76%, which is exactly how much we were up in Monday's session. Kind of interesting. So we really have gone nowhere so far this week, but we were above average with volume. And to see selling coming in and a little bit more conviction on the selling side on above average volume, we want to see if that's going to continue, or was this just some kind of an event that happened in Tuesday's session? We're still positive in the short, intermediate, and long term. No real changes as far as inflation is concerned right now. But interest rates, as I said, we're getting a little bit closer to that 4% level with the 10-year yield. We want to keep an eye on the geopolitical things. Now, oil's actually going down. It dropped quite a bit. We're back down around $70, about 70.53 or so with oil. If things really continue to escalate between Israel and Iran, you could see oil going up, and that could have an impact on the market. Some comments. Semiconductors. There was a report that came out that was not taken as very friendly, and that put a lot of the semis under pressure in Tuesday's session, and that's really what brought things down. Because of the decline, the VIX is back up over 20 now, and that's kind of the line where when we're above 20, we see negative annualized returns, and that's can put some pressure on stocks. We're still getting a lot of high readings from some of our VIX signals that we look at that I'll go through here. And then United Healthcare came out with earnings, and that's what really pushed the Dow lower. And with the Dow only being 30 stocks, you get one company, especially United Healthcare. I mean, they're the biggest in the Dow, and they're having a bad day, and it's going to drag the whole Dow down with it. We're keeping an eye on what's happening in the Middle East. We're at 70.58. I don't remember what I said, but right around the 70.5 level now for oil. And our list is quite a bit shorter now in the short term. It had become kind of long. We were seeing some things on there that we don't see on this list very often, but a lot of those were taken off with Tuesday's decline. But we still have the CCI 14 and 20 and the stochastics that are extreme. And our list is a little bit shorter here in the intermediate term too. The Arun indicator, the PMO studies. A new addition to the list is the rate of change going back 50 periods. The Sean trend meter, the bullish percent index for the S&P, the 100 period moving average study, and then the 10-day new highs, new lows for the S&P. Other than the rate of change 50, a lot of these have been on the list now for a number of days. And then longer term, the 200 period moving average study, that dropped off the list. But when we look at the 150 and 200 simple moving averages, they're still extreme, which again, you can take that another way and say that's showing good long-term momentum. And then the exponential moving average based on 200 periods just on the S&P itself. We haven't changed the scenario yet. There's really been not much that has happened to change this, that the Fed did come in and cut rates. It looks like they're going to cut them another 25 basis points at the next meeting and then the meeting after that because this soft landing scenario still seems possible, that we're not going to go into a recession. The dollar was up and interest rates were down. We're at 4.04% with the 10-year yield, where after Friday, because the bond market was closed on Monday, we were at 4.07%. We're still inverted with the 10 to the 3-month. We're still uninverted with the 10 to the 2-year. Sentiment is positive. We got up into that extreme positive area, and that was one of the concerns that I brought out in yesterday's video. When we get above 75, that's where we start to look a little too positive. Well, with the decline, we came down. We're still positive, but we're now giving a reading of 70. We're still positive with our trend. We're still above the moving average. Now, with the down day, the bias is negative, but our momentum, I'm still keeping it positive for right now. And we just had the New York Fed Empire State Manufacturing. They actually expected it to be up too, but it was down 11.9. Last time it was up 11.5. So this was quite a bit weaker than expected. And here's a chart of that, where it had been showing some overall improvement here in 2024. It actually went positive in the previous reading and then dropped back down to negative in the reading that we just had. Looking at the technical score right now put out by Simple Visor, we're coming in at 84.01, which could be considered a little extreme. We're turning red here with their line. But even, and this is before Tuesday's decline, we still have more room to run to the upside, according to this chart. But this will probably come down a little bit after Tuesday's decline, and then if we see any more declines as we go throughout the rest of the week. And then this is interesting too, that since we're in a really positive environment, we have a lot of companies coming in and buying back their own stock. Well, when they're coming out to report earnings, there's a blackout period now. And we kind of are topping out right around this time or so. We're just coming off of when this is the most right now. So this could put some pressure on the market because companies coming in and buying their own stock, they're buying billions of dollars worth of stock, and that pushes prices up. Well, when they can't do that, those buyers aren't coming into the market, and that could actually cause some selling to take place, or at least a lack of advancement with the indexes. And looking at the earnings, the U.S. still has a very high PE ratio compared to the rest of the world. We're above that 20 level. When we look at PE ratios, we use the 10, 15, and 20 scale. And when we're above 20, that means we're expensive. Well, that's what we're looking at right now. And all the other areas that are measured here are still under 20, with China and the UK coming in very low. We're seeing a lot of money, and I'll show you a chart here in just a second, going into emerging markets because since they have a pretty low PE ratio, folks that use that as a decision when they're deciding to get into a stock, they like that stocks are just a little bit above being inexpensive, and so they'll go into those areas. And then this is the commodity traders advisors exposure to equities. Now, in yesterday's video, I showed some research posted by Goldman Sachs that I found on Twitter that says that no matter what happens, these folks, the CTAs, plan on selling. Now, I don't know how they calculate that, and I've shown that chart once in a while whenever it's available. It didn't really seem to have much of an impact, that if I recall things correctly, but we still, pay attention to those things. But we're seeing a pretty healthy allocation when it comes to stocks, according to the commodity traders advisor, trading advisors. And this is where we're seeing an awful lot of money going into emerging markets right now. Folks see that as a good deal. They like how the economy is shifting around. They're okay with how things are going in the US, so now they're willing to look at other markets. And then it says here, according to Deutsche Bank, our forecasts for earnings imply a 5.2% beat. So that's pretty much in line with the historical average right here. So if it plays out the way they anticipated, earnings season should be pretty positive for stocks. And then what is it looking like if we're going to go into a recession, especially looking out? These are just different models that are used in different indicators. And the 12-month forward implied change in the Fed funds rate, that's predicting still could be a recession out there. But when you take all of these different things together, this is coming up with a 3% chance that we're going to go into a recession. But again, that we're already in a recession is 3%, that we're possibly going to go into one in the next year is at 35%. But that could change at any time. And then we're seeing high yield fund flows. Now, when I did the intermarket analysis video over the weekend, we're actually seeing where a lot of people are getting back into high yield funds. We also call them junk bonds. But here it's seeing where money is coming out right now. And we're seeing the 12-week average still going down. We're keeping an eye on that to try to figure out, okay, what's going on? What's the scenario behind why this is actually happening? Is that a shift that we're seeing in the US economy? And because we saw interest rates really coming down with government bonds, and now they're starting to go back up. And as they were going up, folks were getting more into these high yield funds. At least that's what I was seeing. But this chart kind of goes against that a little bit. Excuse me for having to clear my throat so many times. And then a move higher in yields is confirming relative strength in cyclicals. Cyclicals are stocks that if the economy is doing better, those stocks do better. If the economy is under pressure, those stocks are also under pressure as well. And then they compare it to the 10-year yield here. And that's been going back up. And we're seeing cyclicals actually doing okay now as far as performance. Now, we keep a close eye on this. I look at it as growth versus value and discretionary versus staples. And we keep an eye on the defensive areas because they've been doing really well lately. But this is more longer. Well, this isn't really longer term. But if you take longer term looks at these different interactions with each other, we're still doing okay. We're just taking shorter term looks to see if we can see subtle changes that are actually taking place. But right here, this is looking more positive for the economy. I didn't spend any time on Twitter. Here's the intraday chart where we actually had a bit of a higher open, and that helped to produce a whole lot of new highs. But then that was it. We came down and we dropped below the unchanged level. Excuse me, and we dropped down below the daily pivot down to S1, and we kind of hung out there for a while. Well, instead of going back up and getting some support, we actually broke lower and went down to S2, chopped around there near the end of the day, and then closed slightly above S2. Not really a big change in the initial overnight session with the futures right now, but this is just showing where the futures were actually holding up okay. That's this lighter blue area. It was during the market session when things started to see more selling. And we did see a bit of a drop off both with the intraday chart of growth and value here. We're seeing the blue line a little bit below the red line. It's not too far away right now. They were pretty much matching each other. And if you look back over this, when we see the blue line above the red line intraday, that's when the market's really going up. When the red line is above, then that's when we're getting a little bit nervous about things. And we saw a real drop off in the growth to value ratio with the S&P on the intraday chart. But later in the day, we did see some improvement coming in. End of day growth was down 1.16%. Value was also down, but a lot less. And it was down more for the mid caps and it was down for the small caps where value was positive. So we saw a real decline here. We're still negative overall when we look at the small cap growth to value ratio, the mid cap growth to value ratio, and a drop off here with the S&P growth to value ratio. This had been something that I was pointing to as looking more positive. It's still doing okay for right now. It's just, are we going to see more follow through to the downside, or is this going to be able to turn and go back up? And we're not seeing any real strength here with the growth to value ratio when we look at the ETFs. We're still kind of going to the lower end of the rainbow right now. To be more positive, we want this to break out above the rainbow. If we turn more negative, we're probably going to drop down below the rainbow. Here's discretionary, which is looking okay, at least by itself, but Staples had a pretty good day, so the ratio went down. But we've been watching the discretionary to Staples ratio. One thing that I've been warning about is it's not so much that we were seeing a lot of strength in discretionary, it's that we were seeing more weakness in Staples, and that's what was causing this ratio to go up. Large cap growth did pull back over 1%, but still looking positive there. Our trend is still positive, even though the green line did come down. It's on top, so we still have a confirmed positive trend. Now, it's where do we go from here? If we see more weakness, then that could put more pressure on the positive aspect of this chart. And then in the short term, we also turned down with the green line, but we're still looking pretty positive with a confirmed trend, even in the short term here. And volume did pick up. Now, when you look at the daily chart, we were above average. This is an oscillator, so it takes a while for it to actually pick up and include the other days in its calculation. But we really saw a turn up in volume there. And we're back above 20 with the VIX, both with the line chart and the bar chart, which is a concern. And we went back up here with the VIX of the VIX. We're kind of a little above the moving averages now with the bar chart, and we closed above this with the line chart as well. And the momentum for the VIX is still up as measured by the MACD. Now, it had been starting to come down, but when we went back up in Tuesday's session, that's turning the MACD up slightly. And we're still trying to see if we're going to pair up here with seasonality, where typically the VIX going up during this time of year, and then it really tends to drop off about halfway through October, which could be some positive seasonality that's coming in. But we've just totally bucked the trend. We didn't really play out in September the way things typically do, at least historically have done. So if we see a real upward move with stocks, which means the VIX is going down, is that going to be the opposite this year? It's like the market, it's not really sticking to historical norms right now. And we're seeing that here with the VIX and S&P correlation. We're still getting a high reading above the dashed line, meaning that the market is nervous. And the skew index did decline here, but we're still in this red area. This is another concern that the market is still anticipating some kind of a big move. We declined with this fear gauge where we went up slightly with this other fear gauge. So we're getting some contradiction there. Came down a little bit, but overall, we've been going up with our risk on to risk off ratio. When this is going up, folks are favoring stocks, even though it pulled back on Tuesday. We look at the ratio between large caps and small caps, where large caps were under pressure, small caps just barely eked out a positive close. So we're coming down a little bit, but we're trying to look at the bigger picture here. Overall, this is still tending to go up as large caps are outperforming small caps. The equity pull call ratio with the down day, we really went up with the daily chart and we're turning, it's really hard to see, but we're turning back up slightly with the 5-day chart, but we're still extreme right now. And here's just a longer term chart of that same 5-period moving average, just to give you a little bit more context. This is the area where this usually goes down when the S&P is going up. And if we hit one of these extreme readings and then turn, that may put some pressure on stocks. But we're still declining with the 10-day average of the put call ratio. Coming down, but still getting a pretty high reading here with volatility risk premium. So there's still fear in the market right now. It came down a little bit since we're declining, but we're wondering, okay, is there going to be more selling after this that's going to come out of these charts that we're seeing? Because there's fear. People are waiting for fear. It's just we've been continuing to go up. Now that we're seeing at least one down day, is that going to lead to more down days after this? And the advanced decline line based on price was pretty much flat, still looking solid overall. We were also flat, but coming off of setting an all-time high here based on volume as well. And this was the real, right at the open, we saw, since we had a positive open, a real spike in the new highs right here. It's not really doing much to change our 5-day moving average, but our 10-day moving average is still going up. So this is still showing strength in the S&P, that things are looking okay. And we declined a little bit, but we're still above zero with our advanced decline ratios that we follow here. We're above zero based on price. We're still above zero based on volume. So not a lot of damage was done there. Coming down a little bit with the boom indicator, but we're still positive here with accumulation distribution. We were a little bit concerned after Monday. This was giving us a very high reading. Now it's coming back down and no longer extreme positive. But taken together, this chart is still positive. But this is a concern. We're still declining with the Chaikin money flow. Now, I was attributing a lot of that to the volume being below average. And then you combine that with the down day, and now this is looking a little more negative here. But it's still positive since it's green. But what I'm picking up on is this red line continues to go down. And this is another smart money indicator. And we declined here with the Chaikin oscillator, but we're still above zero. So it's positive. And we declined with the vortex, even though the green line's still above the red line. Don't see much here. We were a little bit weaker with the S&P 500 than the NYSE advanced decline line. And we look at the cumulative advanced decline line for the S&P based on price, not really changing all that much here. And based on volume, not an awful lot of change here either. It's still looking quite positive. Then we look at the cumulative advanced decline line for the NYSE. It did come down after setting a new all-time high. The regular NYSE advanced decline line is not really showing much weakness. And our other NYSE advanced decline line, which is calculated in a slightly different way, is still looking pretty solid there. The common stock on the NYSE based on price haven't really broken out from this previous high. Came down a little bit, but set a high on Monday. So our advanced decline line still looking pretty good here. Just a little bit of a flattening out with the NYSE common stock, flat with the S&P, flat with the mid caps, and still going up slightly with the small caps. And we're still above zero with the percent of stocks above their 20-period moving average. We're above 50. So we're positive here, even though it did decline a little bit. We declined, but we're still positive with those stocks above their 50-day moving average. We came down, but we're still extreme with those stocks above their 100-period moving average. And after being extreme, we came down and no longer extreme with those stocks above their 200-day moving averages. In the short term, the real takeaway here is we saw a spike up in volume for the S&P. For the first time in a number of days, it actually picked up and went above average. We came down a little bit, but still looking positive with the 20 period. We're no longer extreme positive with the 50, and just barely extreme positive with the 200. And this is measuring just the S&P itself, not the stocks inside of the S&P. We're no longer extreme positive with the Stochk RSI or the Williams percent R, coming down but still extreme with the CCI 14 and the CCI 20. The stochastics not extreme in the short term, rolling over in the intermediate short term, still extreme positive in the long short term. That's a further subdivision of the short term time frame. A little bit of a decline here, but still looking positive with the force index. The condition of the 20-period moving average coming down, but we're still pretty much matching up with the blue line and the green line here. And we're still well above the simple and exponential moving averages, even though we've had a pullback thus far. No longer extreme with the standard deviations chart. We had come into the +3 channel. Now we're back into the +2 channel. We declined, but we're still positive with the balance of power. Here's the condition of the 50-period moving average, which is intermediate term. Yeah, we came down with a red candle, but we're still above the red line and the blue line. Still positive with the go, no go with the darker blue bars. Coming down after giving us quite a high reading here with the highest high value, pulling back a bit, but still looking positive for the time being. This is something we have been watching, though. We're still declining with the TTM squeeze. As we've been going up, we've been seeing this oscillator going down, and with the darker blue, that's more negative. Here's the rate of change going back 50 periods. We shot above this 10 level here, a red line, which I put on here, so there's nothing magical. But you can see other times when we got up to similar readings, sometimes that had some kind of an impact on the market. Ease of movement did decline a little bit, but still above zero, so it's positive. The Arun, after giving us a really extreme reading, is still giving quite a high reading as we're above zero with the oscillator. And we declined with the McClellan oscillator, but we're still above zero. So we're going up based on price with the summation index and volume. So that turned positive after Monday, and it's still positive after Tuesday. But we have not been able to climb back above zero with the NYSE McClellan oscillator, and it declined slightly. So we're still going down with the summation index based on price. We're actually turning up just a little bit based on volume, which could be positive if volume is leading price. We're going up with the Swenlin trading oscillator based on price, but we were flat based on volume. So we're seeing a little bit of a contradiction there. Momentum is trying to turn back positive. When we look at the PMO by itself, it's now above its moving average. Turning back up, it's still below the moving average with price. Turning back up also and turning slightly positive with volume. So we saw a little bit of a decline here with the PMOs that are rising. We're now flattening out with the buy signals. Still getting an extreme reading here with the PMOs that are above zero. And as I like to point out, this study right here, these are all the stocks in the S&P 500. And what is their price momentum oscillator doing? And the fact that we're getting a really high reading, that most of them are positive, that just means the whole index is doing quite well instead of just a few stocks in the index. We've gone from positive to neutral with the Elder's Impulse system for the S&P. We're still positive with the parabolic SAR. We were trying to turn up here with the slope oscillator, but with the down day, it's now declining and hasn't been able to really cross its moving average. But we're still looking positive with the MACD. So we're pretty much flat right now with the slope. The TSI, another short-term oscillator, is still looking positive. We're looking better in the intermediate term with the MACD, the PMO, and PPO. We're right on top of the moving average, but trying to improve with the tricks, where we're still negative with the KST. And we're coming down a little bit, but still extreme positive with the Sean trend meter. We declined, but still above 50 with the money flow. Declined, but still above 50 with the ultimate oscillator. Decline, but still above an advancing moving average with on-balance volume. And we had become extreme positive with the RSI 9. That's more short-term. We're no longer extreme. We declined, but we're still above 50 with the 14, as well as the 9. When we're above 50 here, that just means there's good, solid momentum. Even with the decline, we're still above all the plotted moving averages. The bullish percent index is still looking pretty solid and giving us quite a high reading, which can be a bit of a concern. But until we see more follow through to the downside, this is still looking positive. And the NYSE bullish percent index actually went up and is giving us a really high reading, showing good strength there. We did decline with the NASDAQ 100 bullish percent index, but we're still above 50. And just looking at the weekly chart to get a bigger picture perspective here, we're pretty much unchanged on the week right now, but still looking positive overall here on the weekly chart. And we didn't see much of a change as far as our trend. The Heiken Ashi is still positive with the open candles. We're pointing down now, but we're still black with the Kegi chart. So it's positive with a slight negative flare to it. The Renko chart is still positive, and the three-line break is also still positive. Long term came down just a little bit with the 150 and 200, but we're above this red line. That's why I consider this extreme positive, but this is also showing good longer term momentum. Still positive with the market models, according to the Keller market model here on all the different indexes with all the different time frames. And we're negative in the short and intermediate term with bonds based on price, still positive in the long term. Commodities have now gone down in the short term. They're still up in the intermediate term and negative in the long term. The dollar is now seeing a short term uptrend, but still negative in the intermediate and long term. And the areas that kind of held up better, real estate, it likes that interest rates are coming down. We're going to get some real estate information throughout this week. Staples, another defensive area, they did pretty well. Utilities made a little bit of a bounce back. We do like the discretionary was up and communication was up a little bit, but you can see energy just got hit, tech. And then with United Healthcare being a major component in the Dow, healthcare ended up getting hammered pretty good, but it's more of a defensive area. So we saw the Dow setting a new all-time high right after the open, and then everything else turned red after that. And a lot of the movement that we saw down was in the NASDAQ. And the tech sector had a BPI cross below 80. That's a very high reading, and so now it could be rolling over. We're seeing a materials BPI cross below 70 here. That's more economically driven there. And not really a big disconnect between the weighted and equal weighted version of the S&P. The Dow, and we're watching this pivot point. There's a pivot point too that we're keeping an eye on the S&P that may be acting as overhead resistance. We came right up to this R1 level, and then that's when the Dow started to come down after setting an all-time high. Well, it set an intraday high, but it set a closing high on Monday. The diamonds have gone from positive to neutral with the Elder's Impulse system. And I couldn't show the NASDAQ charts in yesterday's video. There was erroneous data. It had the intraday low being 0. So the chart was really all crazy. Well, they went back and fixed that. Now, if you look at this, we're still looking okay here. We're making a series of higher highs and higher lows. Now, if we break below that, that could turn this chart a little bit more negative. But for right now, the integrity of these bars seems to be intact. We're seeing kind of a similar thing here. We dropped a little bit further down with the NASDAQ 100, but we're still above the 50-day moving average. And we've gone from positive to neutral with the Elder's Impulse system for the Qs. The momentum rolled over a little bit, but it's still positive for the NASDAQ 100. Small caps up just barely, but you can see they set their high and then they closed pretty much right down near the low, but they still ended up being positive on the day. Still fairly range bound here, not really breaking out, at least yet. We look at the Russell 2000 small caps, still above 50 with the RSI. It's closing well off of the high when we look at the bar itself, but trying to turn back and look positive here with momentum as measured by the MACD. We continue to be positive with the Elder's Impulse system for the small caps. And mid caps, same thing, only they ended up closing down. So they saw a lot of their strength earlier in the day and then closed pretty much at the low. But they're still positive with the Elder's Impulse system for the mid caps. And Wilshire, a broad market measure, after setting an all-time high on Monday, did see a 0.67% decline on Tuesday. Also a 0.7% decline with the total U.S. stock ETF after setting an all-time high on Monday. We're coming back up just a little bit here, but overall, we've been declining with the staples to tech ratio, but we're still concerned because this ratio is showing an uptrend, meaning that staples are in an uptrend compared to tech with this ratio. If this can continue to go down, that would be more positive for the market and eventually see this blue line cross back below the red line, which would be a death cross for this ratio. Financial sector was up, looking pretty solid there. FANG index down 1.39%, not setting an all-time high on Monday, still having a way to go to get back to the highs that were set last summer. And we're kind of bouncing in between right now. We're still above this longer-term trend line, but still below the shorter-term trend line with the FANG index. Apple was up over 1% and looking pretty solid there. Amazon was virtually unchanged, but still looking pretty good. Meta was down 0.7%, but still looking pretty solid that way. We're watching Microsoft here. We're getting close to a death cross. And You can see over here on the left, the 50-period moving average is 418.35. The 200-day moving average is 417.04. So we're still positive. If the blue moving average, the value becomes less than the red, that means we've actually seen a death cross here. So we're keeping an eye on this one. Google was up 0.3%, also seeing that moving average coming down quite a bit, but still has a little further to go to actually produce a death cross. Nvidia got hit pretty hard after having a good day on Monday with the semiconductors. Tesla was virtually unchanged, but still under its 50-day moving average. Netflix was down almost 1%, but still above its 50-day moving average here. And we're seeing more of a short-term deterioration between U.S. stocks and world stocks as the 10-day correlation continues to decline. Seeing a little bit of a decline here with our longer-term correlation based on 50 periods. Oil dropped down. We're at 70.58 right now. The dollar is in a downtrend, but it's just been bouncing back up into the 103 range. And we had bonds open on Tuesday after being closed on Monday, where the 10-year yield did decline. The 10-year based on price did go back up. And dropping a little bit below the moving average when we look at the Qs to S&P with our growth to value ratios. A little bit of a tick up, but now below a declining moving average with discretionary to the S&P, and pretty much on the moving average when we compare large cap growth with large cap value. So large caps kind of right on the moving average, turning down but above the moving average with the mid caps and coming back down to an advancing moving average with the small caps. And overall, we've been declining with the S&P to utilities ratio. We want this to go up to be more positive. If this continues to go down, that would be more negative for the S&P. And we ticked up a little bit, but overall, we've been declining with the Staples to S&P ratio. We want this to continue to decline to be more positive. If it goes up, that will be more negative. And just to update here with the Hindenburg chart, there's nothing really to update other than the date was changed here. There's no new confirmations here, so we're just keeping an eye on this. So what's our outlook for Wednesday? We're still positive. We have this Hindenburg omen that's been confirmed now by 2 spikes. And I'm keeping weak seasonality in here, but it's like, we really haven't been following it all that much. And we're possibly coming into a period of positive seasonality, at least a little bit here as we work our way through October. We're still getting multiple VIX signals that are flashing now, which we would more or less default to negative with that. And we saw them wear off a little bit in Tuesday's decline, but we're wondering, is there still more to go with that? We're going to get the MBNA Mortgage Applications Index and import and export prices, not major reports. And we want to keep an eye on all the crazy stuff going on. Plus, there's the whole presidential election. So far, none of that seems to really have an impact on the stock market, but that could always change. Thursday is going to be the big economic report day. On the next chart here, here's what the previous readings were and what their forecasts were, if they have a forecast for that. Seasonality, we're neutral to positive with the Dow, but when we look at October 16th, the S&P and NASDAQ are just flat out positive. So, at least based on a historical basis, that could end up being a good day, but we'll look at some other charts here in a moment. We are dealing with options expiration week, where we tend to be more up than down historically during this week. And this is where we see some potential positive seasonality right here, but then we just kind of chop right back down for the next day before we see a little bit more positive seasonality going forward into options expiration. And Wednesday, at least in 2023, was the most negative day of the week, but it's not doing great. But so far in 2024, at least it has a positive annualized return. And we're just wondering about seasonality. We don't seem to be really sticking to that right now. And that's why we just use it as a guide, not to make decisions. So the warning signs, we do have this confirmed Hindenburg omen, the weak seasonality, which who knows where that's at right now. We're keeping an eye on these defensive sectors, which did better in Tuesday's session, like staples, utilities. Healthcare got hammered, though, because of United Healthcare. And we're watching energy mainly more for geopolitical reasons. We're keeping an eye on the growth to value ratios. And discretionary by itself is not doing all that great, but it's doing okay when we compare it to staples with the ratio. We're still getting a lot of VIX signals that are flashing, and we're back above 20 with the VIX. And the NYSE McClellan oscillator and summation index continues to be negative. And our oscillators, they're still they're trying to switch back and showing some improvement there, but we haven't quite gone over to full-blown positive at least yet. The positive signs, we have accumulation distribution, but it's coming down a little bit. It's no longer extreme. The chicken money flow, that is more of a concern to us. We've been seeing that even as the S&P was going up, this was starting to go down. And the chicken oscillators, it's chopping around, but because of the down day, it is now declining. The 5-day equity put call ratio is extreme. Even though it's ticking back up a little bit, we're still getting an extreme reading, which could end up being negative for stocks, but we're still going down with the 10-day. So for right now, we treat that as positive. We are positive with the S&P McClellan oscillator and summation index. And our advanced decline line is still looking good there. We're still extreme positive with the S&P bullish percent index. We're still looking positive with the NASDAQ and NYSE bullish percent indexes. The parabolic SAR, the vortex, the Swenlin trading oscillator, we're still going up based on price. We were flat based on volume. The money flow, the ease of movement, and ultimate oscillator. These are secondary indicators that we use just to confirm what we're seeing with our primary indicators. They continue to be positive. The momentum, even though it rolled over a bit for the NASDAQ 100, is still positive, and the financial sector is still looking pretty good. So our conclusion, we're still positive. We have these things in the background like the VIX signals, the Hindenburg-Ullman, the potential weak seasonality. Other than what we saw on Tuesday, the market really hasn't been paying attention to those. But we're going to see, are we going to see more building of the selling? Are we going to see more negative action going forward from here? We're working off being overbought in the short term, but we're still positive. As long as we're above that 20-period moving average, we're also still positive in the intermediate term. But our list isn't quite as long as it was after Monday, and we continue to be positive in the long term. Thank you. I hope you found this helpful. I hope you have a really good day, and I will talk to you in the next video.